Hi, this is Jim Gillespie, and I'm excited to be here with you today because I'm going to be interviewing one of the top economists in the world, and we're going to be talking specifically about what we can expect to see in the commercial real estate market here in the US in 2025. I'm going to be interviewing Richard Barkham of CBRE, and in moving forward, let me give you a brief introduction for Richard. Richard Barkham is the global chief economist for CBRE. He leads a team of nearly 600 research experts who help CBRE's clients understand the forces shaping the commercial real estate industry. He's one of the world's leading real estate economists, and he's a frequent source for both clients and journalists worldwide who are navigating moments of economic volatility. And with that being said, there's really not much economic volatility going on these days. So with that being said, let me bring Richard onto the call here. Richard, it's so exciting to have you here. I'm so thrilled and glad that we got this opportunity, and I'm looking forward to doing this interview together. Welcome.
Oh, well, thank you, Jim. I'm delighted to be here.
Wonderful. And let me give everybody a brief idea of how this interview is going to go. I'm going to start out by asking Richard what specifically he sees going on in general in the commercial real estate market here in the US in the coming year. And then I'm also going to ask him what he sees going on with interest rates. And in follow-up to that, then we're going to get into the individual niches and talk about what to expect in multifamily, in industrial, in retail, and then in office space. So with that being said, Richard, why don't you start out and tell us what we can expect overall in the coming year in the commercial real estate industry?
Well, the way I like to characterize this for most of the presentations I'm making at the moment is I think that the macro economy is solidly mid-cycle. So I think we can expect to see continued economic growth through 2025. But I would say that real estate sectors, as a generality, are end of cycle, moving into a new cycle. So we've got elevated vacancy in offices, in industrial, and in multifamily, not so much in retail. And I expect those vacancy rates to fall a little over 2025, and a degree of rental growth to ensue. It depends a little bit on the changes to economic policy that might come about as a result of the US presidential election and Mr. Trump taking the reins of office. But from this perspective, it looks like good growth and a little bit of a revival in the real estate market.
That is so wonderful to hear. And in general, what are you forecasting for interest rates too?
Well, interest rates, I think, will be higher for longer. That comes out of the relatively robust economic growth that we've had over the last couple of years. There's relatively little slack in the economy with unemployment low. Wage growth is still probably above, that which the Fed would think is consistent with 2% unemployment. So I definitely think that interest rates will be higher for longer. And I'm talking particularly about the 10-year Treasury, which is notched up to 4.6%. We've got a forecast of that being around 4% by the end of the year. I'd say a range of 4 to 4.3% by the end of the year, I think, is what we're thinking about. I do think there is scope for further cuts in the federal funds rate. Inflation is coming down. There is some stickiness with service sector inflation, but I suspect we'll get 50 basis points of cuts as some of the catch-up inflation of the last couple of years, finally feeds out of the system. So, I mean, that's not quite as low as people were expecting even 6 months ago. Where people were pricing in probably 75 or 100 basis points of cuts in 2025. But it is heading in the right direction.
And that's the most important thing. A 50 basis point drop is better than a 50 basis point rise, okay?
That's for sure. I mean, a lot of people are talking about a 50 basis point rise. They're looking at the solid growth in the US economy, and they're looking at that sticky inflation. But I think that's probably overstated. I do see, if you look closely at the inflation data, there's enough there to suggest that inflation will, even if it trends up a bit in Q1, trend down for the rest of the year. Having said that, as I say, there are policy shifts afoot, and we will need to, keep a close eye on inflation
Absolutely.
because of the potential policy shifts.
I understand, but that's good to hear that there's a reasonable chance that the inflation may ease a bit throughout the year. That's wonderful. Okay.
Yeah.
Now let's go sector by sector here. So why don't we start out with what you're seeing happening in the multifamily sector?
Well, I think multifamily, it's one thing that I think that convinced me that the interest rates weren't having a really negative impact on the economy. When I saw the multifamily absorption rates, they were very high. I think around 150,000 units in Q3. It might be a bit less, it might be a bit more in Q4. And people, don't sign leases if they're nervous about the economy. So I think the multifamily sector is telling us a good news story about the economy. But what am I seeing in the sector? I'm seeing the fact that mortgage rates are high. Is preventing people, not completely, but preventing people buying homes. I'm seeing, confidence about the economy, confidence about the jobs, people willing to form households. And I'm seeing all of that demand channeled into the multifamily sector. Now, it's true that in multifamily that we've had, about 18 months, and we've probably got another 12 months of very, very high levels of new completions. The COVID era and the stimulus and the fall in interest rates really stimulated a big investment, development or construction boom. Now that's coming to an end. We still have another 3 or 4 quarters of elevated, by which I mean 100,000 plus units per quarter. But I see sufficient demand to be able to accommodate that. A lot of people have been concerned about, the very specific locations, the Sunbelt locations, where a lot of that new construction is concentrated. And it is true that vacancy rates have shot up, to quite high levels, 8 or 9% in those Sunbelt locations. But I think, they've plateaued and they're starting to come down. The thing about the Sunbelt is it continues to attract population. And so even though vacancy rates are elevated in the Sunbelt, I think they will be relatively quickly absorbed over the next 12 months.
That's good to hear. Okay. So with ongoing construction, that's going to keep a lot of people happy with jobs with the subcontractors. And of course, then the filling of the units.
Let's just be a bit careful there. I mean, there's one thing completing construction projects that have already been initiated.
Okay.
I do see, to be clear, new construction starts dropping quite quickly.
Okay.
We see that in all of the sectors. That's going to be true in office. It's certainly true in industrial. And it's also true in multifamily as well. So new starts dropping quite quickly, pressurized, I think, by high interest rates. And I think it's one of the reasons I'm optimistic about the real estate sector is that there's been a big surge in new construction, but that's being absorbed, and relatively low levels of new construction are being initiated.
And there's probably a lot of developers who are going, wow, there's so much new construction and new product been coming on the market. We don't think it's a time to be adding any more to the mix.
I think that's right. Some of the schemes, won't be penciling out, because of construction costs, because of interest rate costs. I think if, having said all of that about new construction, I think if there's going to be one sector that slightly bucks that trend, it is going to be the multifamily sector.
Okay.
I think there is a chronic shortage of housing in the United States, somewhere between 3 and 5 million units. And as I say, the cost of mortgages is making it very difficult for households to buy single-family homes. So I do see continued demand in the multifamily sector, and that's going to encourage some of the developers to to break ground. But I think that the overall level of new construction is going to be markedly down.
Okay. All right. So let's segue into the industrial sector. What do you see happening there?
It's a very interesting story. Yeah, we got. I think we're aiming for. Well, 2024 would have been, I think, the third highest year on record for industrial leasing. So that is gross leasing. Now, if I could be a little bit technical, the levels of net absorption, net leasing, if you like, the balance between new space leased and space released, are actually relatively low. So what that is telling me is that companies are moving out of older space into newer space. And they haven't been able to do that for 4 or 5 years. Vacancy rates have been so tight. But as with the multifamily sector, there's a big wave, maybe 500 million square feet of space, coming onto the market in 24 and 25. And with the economy motoring along quite nicely, particularly consumer spending, then I think logistics companies are taking the opportunity to move out of their older stock into modern facilities. And again, I think we've seen a rise in vacancy in the industrial sector, but I think that's peaking out now. The level of new starts of industrial construction are dropping quite quickly. By the end of 2025, I think we'll be moving into quite a tight market in industrial. And I think that opens what we will begin to see is redevelopment of older industrial facilities that have been vacated.
There'll be a lot of landlords who would be happy to see a tighter market and a lower vacancy rate coming around.
Well, yes, I think that's right. I mean, but during COVID, we saw sort of rental growth of maybe 15 or 20%, and that's all very well for landlords. But I don't think it's healthy overall as a market balance. What it tends to do is really, it presses all of the buttons to stimulate new construction. So you end up getting a whole wave of new construction, and very low vacancy. It's not good for companies either, because they can't lease the facilities that they need. I think we need a balance of maybe 6 or 7% vacancy. If it gets too low, it's good for a short period for landlords, but it's not good in the longer term.
I've heard stories about that in industrial with companies needing to move into another building, but it's like, where can I go? There's nothing that fits our needs that's available, and being right up against the end of their lease and going, what are we going to do? And you're right.
Those acute supply shortages, they distort the market, and they're not really good for anybody in the longer term.
I agree. All right, so let's move on now to the retail sector. Tell us what you see going on there.
Well, the retail sector is having a moment of great success. Following maybe sort of 10 years of headwinds since the growth of e-commerce really got underway in the 2015, 2016, and of course we haven't constructed any new space in the retail sector. So I talked about an end of cycle event in office, industrial, multifamily. We've seen vacancy rates rise. We haven't seen vacancy rates move up in the retail sector at all. In fact, they've gone down. And our brokers are telling us they can't always do deals for retailers, because there isn't enough grade A space available or suitable space available. So I think that the big story in retail is that we haven't developed enough. People have been a bit wary of developing retail space, but I don't think it's only a lack of supply issue. I think consumer spending's been strong, and we've obviously had the post-COVID stimulus, which has boosted the consumer. But I think we're looking back. If you go back longer than that, I think that the decade 2009 to 2019 was was a fairly miserable one for consumers. Unemployment was high, it came down slowly. Wage growth wasn't all that aggressive. So I think what consumers did then was reduce their levels of debt. So now we go into the current situation with good growth, with consumers with relatively low levels of debt. And the labour market is soft, but it hasn't weakened very much. So consumers are in good fettle. There isn't much retail supply. And one final, ingredient of this kind of very potent cocktail is the fact that retailers have improved. A lot of retailers absolutely went through, really tough times in the COVID period, and a lot of them, went into administration. They got rid of underperforming stores. They cleaned up their balance sheets. But more than that, I think, is that they've all adopted a multi-channel strategy. I think traditional retailers were a bit slow to do that in the United States, but I think they've realized if they're going to compete with e-commerce, they've got to have very slick multi-channel operations. So you go into a store, it's not there. The good you want isn't there. Well, it could be on your doorstep within 24 hours or less. And I think that retailers are better, consumers are strong, and we haven't developed enough retail space. So the fundamentals of retail are exceptionally good. Now, I'll add one final part of that. You might be tempted to think that that's good for landlords, and it is good for landlords, and it's good for investors who are seeking to acquire retail. I don't, having said that the balance of supply and demand is very tight in retail, I don't expect necessarily rental growth to accelerate away. And what I hear a lot from retail brokers and retail owners is that the retailers are just too good and too savvy nowadays. They know that there's so much data available for retailers. They can define their catchment area. They know just about how much money they're going to make in that catchment area, and they know they can pay 12.5% of that in rent, and that's what they can pay. So negotiating with retailers, even in conditions of very short supply, is not conducive to really growing rents much above the rate of inflation. However, there is a consistent level of demand, and as I've said, having rip-roaring rental growth is not really good for anybody in the longer term. What you want is good assets, well let, to good businesses who can pay rents at a sustainable rate going forward. That's what gives you the long-term kind of investment benefit, and I see all of those. They're there in retail, and I think it's probably the sector that has the strongest fundamentals in real estate right now.
Very interesting. And who would have thought that years ago, with all the concern about all this online purchasing and people not needing to go to the stores? It's really shored itself up in a way that we couldn't have envisioned at the time years ago.
I'm not saying there aren't areas of concern. I mean, B and C malls are probably still struggling. Mm-hmm. But on the other hand, in the Sunbelt areas where population is moving, there's probably not enough retail, but quite considerably. So there is scope for some construction of new retail space. It's a very, very interesting area, and you've got to remember that consumption is at the heart of the economy, and retail is at the heart of consumption.
Definitely. All right, let's move on to the office sector. Tell us what you see going on there.
It's been a very encouraging year, despite the fact that the vacancy has risen, since COVID from 12% to 20%. We're beginning to see, I think, a turnaround in the office sector, and we've had the bellwether, I think, is the kind of Manhattan market. I've been a student of real estate cycles for kind of a number of years, and I tend to think what happens in New York then ripples out across America with the West Coast, maybe Los Angeles, catching up maybe 18 months later. Anyway, our business in New York is we've seen a very marked increase in the level of leasing of offices in New York. So I think that bodes well. I think we've moved for the last couple of quarters, Q2 and Q3. We don't have our Q4 data in. If I could put that a bit more technically, we're moving out of a situation where we had negative net absorption. The overall balance of leasing was negative, into a couple of quarters of positive net absorption. So I think all that points to a turn in the office cycle. Now, at 20% levels of vacancy, there is a long way to go. And it might take 8 years, it might take 10 years to absorb all of that stock. But I think a combination of economic confidence, the fact that I wouldn't say it's a whole scale return to the office, but there is incremental gains to companies from returning to the office, and the fact that leases signed at the peak of the last office cycle are rolling over, then I think the outlook is quite good for the office sector, for positive net absorption, for quite large, quite high levels of gross absorption. And I think what we've seen very strongly over the last 3 years is a flight to quality. And I've talked about the vacancy rate of overall offices being 20%. The vacancy rate for high quality offices is closer to 15%, and it's going down quite quickly. And I think as companies realize that if they need to renew their leases, or they need to take more space or different space, if they don't move quickly in 2025, then they're not going to be able to secure the best quality space, the space that was constructed after 2010, the space that people want to work in. So, it's, I would say, to summarize, the office sector, the office cycle is turning, and the high grade, part of the market is well in advance of that. And space is being absorbed quite quickly. And of course, same deal for as with industrial and also multifamily, no new starts. So if you're interested in that high grade space, then you need to move quickly, I think, over the next 12 months. Because come 26 and 27, there will be no new completions at all.
Let me ask you a question, because in recent years, we've heard people talk about the idea of converting office buildings, I think mainly older office buildings, to residential. Do you expect much of that to happen at all?
Yeah, I mean, it's picking up. Doubled in 2024. I forget the numbers exactly. Maybe 50 million square feet of space in 23, 100 million square feet of space in 24. And it's, you've got to remember, in the suburbs, those offices are not just going to residential. Some of them are going to logistics. So conversion isn't just to residential. So it's picking up, and I think it's going to gain ground. But it's going to be a long while before the conversion process takes a significant chunk of stock out of the office sector. There is probably 10 or 15% of the office sector which is functionally, technically, locationally obsolete. It's never going to be relet. I think that at the very best, conversion is going to take 1% of stock out of the market, out of the office market per annum. So it's going to take a long time to absorb that space, and some of it is just not suitable. The 70s and 80s or 90s glass and steel construction, that's just too costly to convert. So some of that will just, that will wind down. That will probably get demolished and end up as a parking lot. I do think there's I really think state and local governments, maybe even national governments, ought to really get involved in this, because the quicker that we can speed this transition. America is vastly short of housing, and it is somewhat oversupplied in office. I think tax incentives, maybe even grants, can speed this process of moving from one sector to another, and that really is the secret. It's happening, and people still want to live in cities, but we need to get this conversion happening at a faster rate to see a real revival in American cities. Don't get me wrong, that revival is taking place. It's a question of whether it takes place over 10 years or 6 or 7 years.
Understood. And the demand for more housing units is definitely there. And in so many ways in the major cities, and let's face it, in the big cities, there are older office buildings, which, as you said, are either obsolete or they're close to obsolete. And I've seen about a 40-page white paper on identifying the ideal type of building to do this conversion with. So let's hope that it can be a good resource for developers who want to do it, and for people who are actually needing housing in the major cities to be able to move into these new units.
Yeah, I think
so. Good.
Yeah.
All right. So we've covered the 4 major sectors, and you gave us a general overview. You got anything that you'd like to say to us in summing up what we've talked about here?
Yeah, I mean, I think, if I was speaking to investors, I would be saying, now is a good chance to take opportunities. We've probably seen somewhere between 20, 25, maybe 30% drop in value. Those values are stabilizing now. And, the fact that the 10-year treasury is up at 4.6% is a headwind, but finance is available. And I think there are some good opportunities for, generational purchases in the real estate sector. And they won't last forever. I think 2025 would be a good year to move in the marketplace if you're an investor.
Very good. Richard, again, I thank you so much for taking the time to do this and to be here with us. I feel you've given us, good value, and in the short period of time we put this all together. I wish you all the best of continued success and moving forward. And for all of our audience members who are watching and listening to this, if I can ever help you out with coaching, training, professional speaking, or webinars, let me know through my website at commercialrealestatecoach.com.